Hi, good morning, good afternoon, good evening, whoever you are. Thank you for coming to my channel. My name is Xiang Yi. I'm a private trader based in Singapore. I'm recording this on a Sunday evening, and the purpose of this channel is really just to record down my thoughts for the week, record down my observations in the markets so that in future maybe I can come back to this and review this. And at the same time, if this educational process really does benefit people out there on YouTube, then I'm really happy to be part of your learning process. I think what you see here is on Friday. On Friday, CPI numbers came out higher than expected, apparently highest in 40 years, and that is causing market to gyrate down lower. So you can see some of these indices are down by quite a bit, and actually if you look at the charts, some of them have actually gapped down, so there's a visible gap down there. Not sure if that might fail or not. If it doesn't, then that might become short-term resistance. So in any case, MarketSmith by Investors Business Daily is a tool I subscribe to. I like to use this for a bottom-up approach. But most of the time, or rather, how I do my investment, my investment process, my investment idea generation is I usually do top down first. If I like how things look on a bigger picture perspective, then I'll use a bottom up approach and try to pick stocks. So I usually focus on US stocks, and my style is I'm a trend follower. I am a resistant, relative strength follower, and I'm also a momentum trader. So I like to own stuff that are usually going up, and then you probably want to short things that are going down. And then when things are just choppy and market is moving sideways, I will probably just sit out and stay in cash. So yeah, that's the idea of investing. You want to own stuff that's going up, and you want to short stuff that's going down. So on a broader perspective, I mean, from what we see on Friday, so as we said earlier, markets were down, most market indices are down. VIX came up a bit, and you can see among the 11 S&P 500 sectors, the ones that really were down the least were like defensive stuff like consumer staples, those Coca-Cola, Campbell soup. For utilities, those are like your electricity suppliers. For healthcare, you got hospitals, you got some healthcare pharmaceuticals, and then energy. Of course, we know there's a war going on, so petrol, like oil and gas coming out from Russia is in short supply. So in terms of bonds, we have bond yields going up. We have the US dollar going up as well. And I think if you have the time to see this, like eventually I'll have something on the slides on the other charts. We're broken out of a multi-decade time frame, and it seems that if we hold that on a monthly chart, by the time June closes, that would be a significant change in character in the markets. So commodities, okay. So again, you see a sign of flow to safe haven assets like gold and silver. And crypto is like crypto. Bitcoin has got an important level to watch, would be 30,000, and it seems like it's broken through that. So now it's probably become a resistance. In my opinion, crypto is largely a risk-on asset. It's really positively correlated to the Nasdaq, correlated to the markets in general. It's not something that you want to own in order to diversify your holdings. Okay, so the next one, I think, yeah, let's look at this. So this is the SPY weekly chart. So what we see here is that former support became resistance. Former support here has now become resistance. We tested that a few times last week, the week before, and this time with the CPI numbers down. With the CPI numbers that high, well, we closed a lot further down. And over here is something that this is the PPO. So this measures the the momentum of price changes over a longer, an intermediate, and a short-term time frame. So what we can see here is that across all time frames, the PPO seems to be trending lower, and this is probably not a very good time to be uber bullish. Next chart would be a daily time frame. So recall I said like we gap down, and this is that gap over here. So it's significant because on the S&P 500 there is a resistance at a key round number of 4,000, and there's a gap over there. So that's doubly significant. And if you go back further in time, you can see like we had quite a good run in the SPX, but recently, at the beginning of this year, we finally got oversold. So oversold the RSI 14 indicator. So oversold generally just means it's down a lot. There could be some value there. There could be some sentiment change. When you get oversold conditions, you might get short-term bounces, and rightly so, we did get short-term bounces. But oversold readings, to me at least, it just signifies that it's probably not. And if price confirms, like price continues to be weak, then it probably tells me that it's not a very good environment to stay bullish for the longer term. So to corroborate the findings we got from the S&P, well, this is the Nasdaq, and the Nasdaq composite. So not the Nasdaq 100, not the QQQs, but the Nasdaq composite in general, for all stocks listed on the Nasdaq Stock Exchange. So these are one of the most volatile places in the market. But of course, you also can find your fangman names like your Facebook, which is now known as Meta, your Netflix, your Microsoft, your Google, your Apple, your Teslas too. So this is one of the riskiest places of the market, and you can see it's still a downtrend. It's still a lower high, a lower low, and we are kind of below key moving averages, like the 200-day, the 50-day, the 21 exponential moving average. And also similarly, we got oversold, and RSI has not gotten overbought. So we have not gotten any overbought readings ever since we got this oversold. So this just suggests, maybe there's more pain ahead. And yep, this one is Bitcoin. So Bitcoin is another one that I'll try to look at. I try to pay attention to it. It's also in a downtrend. It's broken some support levels, and it seems like it's not reclaiming that anytime soon. So it's gotten oversold previously, and it still continues to be in near oversold territory. So, oh yeah, and one more thing is, like, if you notice on my charts, I'll use this on the top panel. So as I said earlier, I'm a momentum trader. I'm a relative strength follower. So I want to own stuff that is going up. So in order to outperform like the market or the S&P 500 in general, you want to own stuff that is already by itself outperforming the market. So in this case, BTC had a good run, but with inflation concerns, with the Fed threatening to hike rates even more, with quantitative tightening and all this stuff that is coming out, it's just not really good to be risk on. So this is something on macro, and this is something I learned from Jesse Felder. So Jesse Felder appeared on one of David Keller's interview. If you don't know who David Keller is, he was a former president of the CMT Association, or the Chartered Market Technician Association. So Jesse Felder was invited onto his show, and it was quite interesting to pick his brain on some of the things he sees on a longer time frame. So apparently, so what I have here is due to my subscription, I only have 20 years of data, but Jesse Felder was able to show, based on 40 years of history, that there is some kind of pattern that when S&P 500 earnings, before they drop, it seems like there's a pattern of rising yields, rising crude oil prices, the rising dollar, and then also a drop in consumer sentiment. So he was cautioning viewers and also inviting viewers to treat this, to treat any rallies with skepticism and suspicion, because we are getting leading indicators like this yield, crude oil, US dollar, and also consumer sentiment. They are not in very satisfactory and pleasant conditions. Yep, and why should we be concerned about yield? So, as I said earlier in this video, there is some evidence that we might be breaking out of this downward sloping downtrend line. This is a monthly chart, so we haven't ended the month yet, but if we do close at this level, it seems to suggest that the market regime might be changing, and in an environment where there's rising yield, rising rates, it might be more conducive to be more value centric rather than growth centric. And it could also be noteworthy to put commodities on your radar. So the next chart, it's similar. It's showing the mortgage, the 30-year US mortgage. So mortgage is, and this is a chart of stretching back over 20 years. So it's showing very bullish trend, which is not very good for a home buyer. Lower, so these are higher lows, and then we're getting higher highs. That's an uptrend. And then for this is basically your high yield spread. So apparently what this chart is trying to say is that for a given maturity date, what is the spread between, for two similar bond maturity dates, what is the spread between one that has a lower risk issuer versus a higher risk issuer? So this chart is saying that, well, the spread is rising, which means that any issuer who is deemed as more high risk would have to offer higher interest rates for the same quantum of bond and the same maturity. So this is confirmation of financial tightening conditions. And while this is one person who is widely followed and I highly respect his works, you might better know him for his Maclellan oscillator, which is a breadth indicator. So what he's trying to say is that it seems that the Fed funds target rate has a lot to catch up, because as you can see here, it's the 2-year notes is rising much faster than Fed funds target rate, and in order for this inflation to be brought under control, the Fed funds rate has to be brought up as quickly as possible to match whatever we're seeing on the 2-year note yield. Okay, so sometimes looking at indices, looking at index prices do give us an idea of where the market is, or where the market is trading at. But sometimes for more advanced, for more leading indicators, sometimes it might be worth a while to look at the advanced decline lines, a breadth measure. For example, you want to know, like, not just how the index is doing, but how stocks in general as a whole are doing together. So if you see, like, generally it's back last year, it was generally fine, because you had the S&P 500 still rising, although with a bit of difficulty, but at least the advanced decline line was still on an upward trend. So you can see the 50-day moving average line of the advanced decline line for the S&P 500 was still rising. But eventually, when we got to the beginning of this year, things started to change, and it wasn't just the S&P 500 index. It was also the NYSE common stock. It was the mid caps. It was also the small caps. So the advanced decline line is a breadth measure because it tries to measure how many stocks are advancing, how many stocks are declining. You take the accumulation of that and then you sum it all up into an index. So as more stocks are advancing, as more stocks are rising versus stocks that are falling, you would see the advanced decline line in a very nice uptrend. Well, but we're not seeing that now, and which is why I've kind of color coded everything in red, because they're now below the 50-day simple moving average, which is just a way to smooth out all these erratic movements. Alright, so that's breadth. And another indicator for breadth that I like to use is I like to look at the percent of stocks above the 200-day, the percent of stocks above the 150-day, and the percent of stocks above the 50-day moving average. So in this case, I've chosen the NYSE composite. You can also use the S&P 500. You can use the Nasdaq. I chose to use NYSE because it's more representative of general stocks, not just from the Dow, not just from the S&P, not just from the Nasdaq. So over here you can see like there is a trend of it going down. 500-day simple moving average percent of stocks is down. 150-day simple moving average percent of stocks trading above this value is down, and also the 50-day is also down. So I think until you see some change in character, you see some, I wouldn't classify as us going back into a bullish environment again. The other thing that is nice to see is also high-low index. So what this means is you want to see like so for here you see a lot of red bars because there are more stocks making new lows. So as long as you see more stocks making new lows as opposed to new highs, it's confirming whatever the market indices are showing. So if the market indices are going down and you see more stocks making new lows, that's confirmation that the market is weak. And right now, last Friday we saw a gap down and we saw more stocks, we saw an increase in stocks compared to the prior day making new lows. So this is something that I think breadth is important, and this is just another indicator for breadth. Okay, so well, we'll come to the end of this screen top-down approach. There are some, I also use MarketSmith, and I generally use this as a bottom-up approach, but from my preliminary findings, I think there's not many attractive stocks to look at on the long side. Some stocks maybe you could short, but right now, given how aggressively we gapped down, and given that it was a news-driven event on Friday, I will probably sit out this coming week. I'll probably sit out and then assess the conditions once next week ends. So, well, this is my recording. This is my recording on 12th June, and this is how I see the market. So thank you for viewing my channel. See you.